Hello everyone, welcome back to Boss Economic World. I'm your host. Today, we are going to peel back the onion on the global financial system, expose the gears of the unseen hand, and most importantly, figure out why your portfolio feels like it's riding a roller coaster in the dark. Today is December 9th, 2025. If you are watching this, you are witnessing a moment of history. We are standing at the precipice of the Federal Reserve's final meeting of the year. The consensus on Wall Street is that we are getting a rate cut, the third consecutive one. But my friends, if you think this is a victory lap for Jerome Powell, you are sorely mistaken. This isn't a victory lap, it's a hostage negotiation. We are looking at a Federal Reserve that is more divided, more confused, and more politically besieged than at any point in the last 20 years. The era of come by a consensus is dead. And what is rising from its ashes is a chaotic, high-stakes battle for the soul of the American economy. So, grab your coffee, or something stronger, and let's analyze the truth behind the chaos. Let's start with the elephant in the room. Why is the Fed cutting rates? Usually, you cut rates because the economy is crashing, or you cut rates because you've successfully murdered inflation and you want to be nice. Today, we have the worst of both worlds. We have a situation that economists call a policy dilemma, but I call being stuck between a rock and a hard place with a tiger chasing you. Just last week, ADP released data that sent a shiver down the spine of every CFO in Manhattan. Private payrolls didn't just slow down, they shrank. Companies cut 32,000 workers in November. That is the biggest payroll decline in nearly 3 years. We are seeing the unemployment rate tick up to 4.4% as of September. Now, usually, when you see job losses like that, the Fed hits the panic button, slashes rates to zero, and prints money until the printers catch fire. But they can't do that. Why? Because the ghost of inflation is still haunting the building. The Fed's preferred inflation gauge, the PCE, is sitting at 2.8%. That is nearly a full percentage point above their 2% target. So, Powell is sitting there with just one tool, the interest rate, trying to fix two opposite problems. If he cuts rates to save the 32,000 people who lost their jobs, he risks sending inflation back to 4% or 5%. If he keeps rates high to crush inflation, he risks turning a mild slowdown into the Great Recession 2.0. And to add a cherry on top of this disaster Sunday, they are flying blind. Thanks to the recent government shutdown, the official Bureau of Labor Statistics data for November has been delayed until December 16th, a full week after this meeting. The Fed is about to make a $1 trillion decision based on vibes, guesses, and ADP data. That is like performing open-heart surgery with the lights off. For years, Jerome Powell was the great unifier. He was the dad at the dinner table who made sure everyone ate their vegetables and nobody fought. Those days are over. We are expecting 3 dissenting votes at this meeting. That might not sound like a lot to you, but in the polite, tea-drinking world of central banking, that is a bar fight. This will be the 4th straight meeting with dissent. If we get 3 dissenters today, that brings the total to 8 in just a few months, the same number of dissents we saw in the previous 47 meetings combined. Why is everyone fighting? Because nobody knows where neutral is. In economic theory, there is a mystical number called R*, the neutral rate. This is the interest rate where the economy is neither growing too fast nor shrinking. It's the Goldilocks zone. The problem is, the map to R* has been burned. The doves look at the 32,000 lost jobs and say, the neutral rate is much lower. We are strangling the economy. Cut faster. The hawks look at 2.8% inflation and say, no. The economy is structurally different now. Deglobalization, tariffs, and debt mean rates need to stay higher. If we cut now, we are pouring gasoline on a smoldering fire. Loretta Mester, the former Cleveland Fed president, put it diplomatically, I would be more concerned if there weren't disagreements, the economy could evolve in different ways. Translation, nobody knows what is going on, so we are all guessing. The reality is, Powell's term expires in May 2026. He is a lame duck chairman trying to herd 18 cats who all smell blood in the water. The closest lieutenants of Powell have signaled they are ready to cut, dragging the committee with them, but the unity is gone. This volatility in the boardroom translates directly to volatility in your portfolio. Now, we cannot talk about the economy in 2025 without talking about the man who just reclaimed the White House, President Donald Trump. The president has made it very clear, he wants low rates. He loves low rates. He thinks high rates are a personal insult. This puts massive political pressure on the Federal. If Powell holds the line on inflation, he becomes the enemy of the administration. If he cuts too fast, he looks like a puppet. But here is where the plot thickens. Trump is on the cusp of naming a new chair to replace Powell next year. The front runner? Kevin Hassett. Kevin Hassett is bringing a very dangerous, very seductive idea to the table. It's what I call the AI savior theory. Hassett argues that we don't need to worry about inflation because artificial intelligence is about to create a productivity boom that rivals the internet in the 1990s. The theory goes like this: if AI makes workers 20% more efficient, companies can produce more goods and services for less money. If you produce more with less, prices go down even if the economy is booming. Therefore, Hassett argues, the Fed can slash rates, let the economy run hot, and AI will magically absorb the inflation. Is he right? This is the multi-trillion-dollar question. If he is right, we are entering a golden age. Stocks will double, inflation will vanish, and we'll all be drinking champagne on Mars. If he is wrong? If AI is just a tool and not a miracle? Then cutting rates into a 2.8% inflation environment with a new tax cut and deregulation package coming in January is a recipe for hyperinflation. Most of the current Fed officials are skeptical. They look at the September projections, which they are updating this week, and they only see one cut in 2026. They don't buy that AI will save us narrative yet. They see sticky service inflation, rising insurance costs, and wage pressures. But if Hassett takes the throne in May, the Fed's philosophy could shift overnight from data-dependent to AI-dependent. So, what is going to happen today and tomorrow? Bloomberg Economics and my own analysis suggests a 25 basis point cut is locked in. The market has priced it. If they don't cut, the bond market will riot. But listen to the language, not just the decision. This is going to be what we call a hawkish cut. Powell is going to walk up to that podium, announce a rate cut, and then spend 45 minutes looking miserable about it. He has to appease the dissenters. He has to signal to the market, hey, just because we are cutting, don't think the party is starting. We are watching you. He will likely emphasize that future cuts are not guaranteed. He will point to the delayed data. He will try to keep financial conditions tight even as he lowers the overnight rate. Why? Because of the bond vigilantes. The 10-year Treasury yield is watching the government's debt. With the new administration promising tax cuts and deregulation, the deficit is expected to widen. If the Fed looks too soft, long-term interest rates will skyrocket because lenders will demand a premium for holding U.S. debt in an inflationary world. So, Powell has to cut rates while talking tough. It is a tightrope walk over a pit of alligators. Let's bring this down from the ivory tower to Main Street. What does this mean for your money? 1. The labor market is cracking, do not ignore the ADP data. A loss of 32,000 jobs is a signal. The soft landing is rapidly turning into a hard landing for the working class. If you are in a cyclical industry, brace for impact. The Fed is reacting too slowly. 2. Inflation is sticky, do not expect prices at the grocery store or the gas pump to plummet. 2.8% is the floor right now, not the ceiling. With potential tariffs and tax cuts in 2026, the cost of living is going to remain a headache. 3. Refinancing trap, if you are waiting for mortgage rates to drop back to 3%, stop waiting. The neutral rate debate proves that the days of free money are gone. Even with Fed cuts, long-term rates might stay high because of the deficit fears I mentioned. 4. Market volatility, the stock market loves the idea of rate cuts, but it hates uncertainty. With a divided Fed, a delayed data release, and a political transition, the next 3 months are going to be choppy. The buy the dip strategy might work, but the dips are going to be deeper. We are watching the end of an era. The Jerome Powell era, defined by consensus building and data dependence, is crumbling under the weight of political polarization and economic contradictions. The baton is about to be passed to a new regime that believes in the magic of AI and the necessity of lower rates. We are moving from a Fed that was afraid of inflation to a Fed that might be willing to tolerate it for the sake of growth. As investors and citizens, we have to look past the headlines. The cut this week is just a band-aid. The real surgery starts in 2026. Keep your eyes on the dissenting votes. Keep your eyes on the 10-year yield. And always remember, in the world of economics, the truth is never in the press release, it's in the footnotes. This is Boss Economic World. I'll see you next time, assuming the data finally gets released.